Hey, when you think about your assets, think about it right now. What is the largest asset that you own? And most of you need to utilize this asset for retirement. Do you know what I'm talking about? Stick around. We will fill you in. We have a great show lined up today, folks. Show's called Your Money, Your Wealth. My name's Joe Anderson, certified financial planner, president of Pure Financial Advisors. And I'm with the big man, of course, Big Al Clopine. He's a CPA. He's sitting right over there. We're going to break things down for you today when it comes to home equity. A lot of you are going to have to utilize your entire net worth to have a successful retirement. But for years, touching the equity was like taboo. No, that was the last resort. There's a lot of different things that you can do to have a successful retirement by utilizing every asset that you own. That's today's Financial Focus. Here's the statistics. If you take a look at the yellow bars, this is liquid assets. That would be like an IRA, a 401k, a Roth IRA, or maybe a brokerage account to help people create retirement income. The blue is the entire net worth. Look at the differential here. There is significant equity that people need to potentially tap into to have a good retirement. Now, who owns homes? You know what? Guess what? Retirees own homes. If you take a look at people 65 plus, about 80% of those individuals own homes. 78.5, 55 to 65, 75%. So the people that need the assets the most, guess what? They're owning the homes and they have the equity. Let's break it down. Let's bring on Big Al Clopine. Now, we talk quite a bit on the show about people don't necessarily have a ton of money saved.
Right.
But in certain areas of the country, they have a lot of equity. And for years, it's always been taboo not to touch the equity. But there's some different programs that people can utilize to really enhance their overall retirement income.
Well, there are, Joe. And I think nowadays, now that people are living longer and they're, in many cases, have not saved enough, right. I think it is time to start looking at that home and the equity in it. Particularly if you live in a high-cost area. We filmed this program in San Diego, Southern California, where real estate prices are high. So let's take a look at how you can utilize your home equity. The first one is kind of obvious, right? Downsizing. You can downsize your home in retirement. You can buy a cheaper home. What does that do? Of course, you have maybe a lower mortgage, or maybe eliminate your mortgage altogether. So that's one way to go. Another one is borrow more. That's kind of almost the opposite. But borrowing more may include things like reverse mortgages, which are better now than they used to be. So we'll kind of get into that. Then there are some alternatives to those first two, which we'll get into. And then finally, all throughout the program, we'll talk about the tax consequences of each of these. And Joe, I think this is probably more pertinent now than ever because a lot of the pension plans that our parents' generation, right. They don't have them as much anymore. The baby boomers have not saved enough as a whole, and home equity that's the biggest asset for a lot of people.
10,000 baby boomers, right?
Yeah.
Turning 65 every day
That's
for
correct.
the next 12 to 13 years.
That's right.
And they need solutions to create a retirement income strategy. So let's say you have your IRAs, 401ks, Roth IRAs, and you're taking a look at the overall balance of all of these and saying, you know what, there's just not enough in here for me to do the things that I want to do. Have you looked at the equity? Have you looked at different ideas and strategies of what you want to do? Downsizing is one of them. A lot of people want to potentially downsize, and there's a lot of reasons to downsize, Al.
Yeah, one is you don't necessarily need that large home anymore. You can get by with a smaller home. A lot of people, when they retire, they're looking for that single-story home. They know that their knees may be going or their back may be going. Maybe they want to move closer to the children. And of course, when you downsize, then maybe your expenses will be lower. Certainly, Joe, maybe you can reduce your mortgage or eliminate your mortgage altogether. And of course, in some cases, maybe your cost of home ownership are less just because it's a less expensive home.
You know, I was just in Minnesota visiting my mother.
Sure.
Right? And so she still lives in the home that she raised me on, right? Right outside of downtown Minneapolis.
Yeah.
The neighborhood's a little bit different,
sure.
right? And so there's other issues that you might want to look at. Now it's like, all right, well, maybe she wants to move into a 55, 65 plus community where there's other individuals that might be the same age that have activities that you can get out and do different things. I know a lot of you want to stay in the home, but there could be other reasons to potentially downsize, get something a little bit smaller, and then also you could be a little bit happier.
Yeah.
The financial impact of this, it could eliminate the mortgage altogether, reduce the expenses, and maybe increase those savings just because you might have some capital from selling the other home out.
Well, and I think that's one of the keys, Joe, which is if you downsize, maybe get rid of the mortgage altogether, and then maybe you got extra proceeds, right, for your retirement income. So with those proceeds, you can invest them to create an income, and therefore, think about this. Not only do you not have a mortgage, so your expenses are lower, but you've got more capital to create retirement income, Joe. It can be a win-win for your retirement, particularly now since people are living into their 90s and beyond.
Well, I think, too, sometimes people don't necessarily want to sell their home because they're afraid that they might have a huge tax bill.
Sure.
But there's tax consequences in some cases. In other cases, you might be surprised that you're not going to pay a dime in tax because of the Section 121 tax exclusion. And Al, this has been around for years, and still people don't, because they're still going back an old rule of what, 15, 20 years ago?
Yeah, this is at least 20 years. So you can sell your home, you get a $250,000 gain exclusion if it's your primary residence, $500,000 for a married couple. And here's the thing, you have to own your home for at least 2 out of 5 years. And you can do this every 2 years, right? So a lot of people, the old rule, which is when I started my career, which is a long time ago.
It was.
But the old rule was you could do this once in a lifetime. Now this is every 2 years.
Well, if you have enough appreciation to do that, right?
Sure.
I mean, you get $250,000 if you're single or $500,000 if you're married, excluded from taxes altogether as long as you live in the house 2 out of the last 5 years. And then also in Southern California, there's something that's called Prop 60 when it comes to property tax.
Yeah, and Joe, that's where you can transfer your current property's asset value to the new property, which means you can keep your property taxes low if you've owned a home for a long time. You must be over 55 years old, husband or wife. You can only do it once in a lifetime, and the replacement property must be of equal or lesser value, meaning that if you have $1 million home, Joe, if you buy an $800,000 home, this will work. But if you trade up, you buy a $1.5 million home, you can't do this.
Well, we're talking downsizing, so maybe you sell your $1 million, you buy some for $250,000.
That's the
right?
That's the idea.
We got Wade Pfau. He's going to join us when we get back from the break. He wrote a book. We're going to give that away to everyone right there if you go to yourmoneyyourwealth.com. It's really utilizing the home equity out of your home. So if you want to get a copy of the book, go to yourmoneyyourwealth.com and we'll send it out to you. We'll be right back in just a second. You're watching Your Money, Your Wealth. Hey, welcome back to the show. The show's called Your Money, Your Wealth. Joe Anderson and Big Al hanging out talking about using your home as a retirement asset. Imagine that for a concept. Stick around for this segment. We have Dr. Wade Pfau. Big Al is going to interview him. He's one of the most prolific advisors in our industry. And so he wrote a book, which we just talked about reverse mortgages. So you don't want to miss that interview. But before we do any of this, let's go to the true or false question.
Most baby boomers prefer to downsize to a smaller home during retirement. True or false? What do you think, Joe?
That's false, Alan. Even though we just talked about in the last segment that you should downsize, but 84% of people, I think they want to stay in their homes.
Yeah, that was a study by AARP, and Joe, you and I know from talking to a lot of folks, they don't want to leave their home. They want to stay in their home. And as we just talked about last segment, in many cases, it's going to be a way to access your equity, to reduce your expenses. So it's something that you at least want to consider.
Yeah, so if you're going to stay in your home, so what the heck do you do, right? Maybe you don't have enough capital, so there could be some mortgage solutions for you. And the last thing you want to do is go into debt in retirement So one of the things that we talk about, if you already have a mortgage, you might want to refinance that thing and look at the cash flow. Maybe push that out for another 30 years just to keep that payment as low as possible so it doesn't disrupt your overall retirement. A cash out refinance, that could be an option. We probably wouldn't recommend that, but some people have done that, or maybe a home equity line of credit, just something as a safety valve that they could tap into just in case an emergency or opportunity, arises.
Yeah, and I think reverse mortgages, that's yet, of course, another thing. But Joe, let's talk about tax consequences of borrowing, because when you borrow money, there is no tax that you pay on cash proceeds. It's not income, it's borrowing, so you don't have to pay tax on it, and you can deduct the interest charges, interest costs on up to $100,000 of debt. Now realize with a reverse mortgage, there really is no deduction currently, Joe, because there's no payment being made.
Yeah, speaking of reverse mortgages, I think a lot of people should actually look at this. I mean, they've changed the laws. There's a lot of different things that people can potentially do, especially if you want to stay in your home. I think for years it was always called the last resort. You don't want to do anything with a reverse mortgage until you're completely broke. But Dr. Wade Pfau has kind of changed the face of that and said, you know what, it doesn't necessarily matter. Everyone might want to take a look at this, depending on your circumstances, depending on your goals, depending on what your income needs are and your assets and everything else in between. So, I mean, instead of you and I talking about it, right, well, let's get the big man on.
Let's get the experts. So we have Dr. Wade Pfau. He's the professor of retirement income at the American College of Financial Services. And Wade, thanks so much for joining us.
Thanks, it's a pleasure to be here.
So let's get right into it. Who would qualify, first of all, for a reverse mortgage?
Well, for the home equity conversion mortgage program that's operated through the government, that's the most popular by far, you do need to be age 62 or older to qualify for a reverse mortgage. And there's some other requirements as well, going through a simple financial assessment to make sure you'll be able to meet homeowner obligations and so forth. Having full ownership of the home, although you can use a reverse mortgage to pay off an existing mortgage, and just a couple other issues like that.
And Wade, the other thing is reverse mortgages have gotten a very bad reputation over the past many years, but there's been some new legislation to help change that. So can you go over that? Can you explain that?
Mm-hmm. So yeah, there's been a number of things going on. The financial assessments that I just mentioned is still relatively new. It's part of the effort of public policy to move reverse mortgages from being a last resort option used only when people have run out of other alternatives to just being used by people who are building responsible retirement income plans and who may open a reverse mortgage before they necessarily need to use it, just to allow the line of credit within the reverse mortgage to start growing. There's other protections now as well for a non-borrowing spouse. That was one of the issues in the past, where if one spouse was older than 62, the other was younger than 62. Once the older spouse, they're the only one who could have been part of the reverse mortgage, and once they have left the home, the loan balance would become due, and that could be a trouble for the younger spouse. Now there's protection so that younger spouses are not borrowers, but they can still remain in the home for as long as they wish as well.
And Wade, when it comes to a reverse mortgage, you can either take a lump sum or a line of credit. So can you explain how that works?
Mm-hmm. Right, that is the most confusing aspect of the reverse mortgage, and that's really the aspect of it that drives all of the recent research going back to about 2012 about how reverse mortgages can help a retirement income plan. It's all based on the growing line of credit, and that opening the reverse mortgage earlier rather than later lets that line of credit grow to be more than it could otherwise be. And so to try to explain this as simply as possible, I think it's really a matter that policymakers assumed when people opened reverse mortgages, they would borrow quickly from it. And everyone can understand why, if you had a loan balance that you're not repaying, it would grow over time. Well, the way the reverse mortgage works, you really have this borrowing amount limit. It's called a principal limit, and it consists of loan balance plus line of credit. So anything that you haven't already borrowed that's not part of your loan balance, it's instead in the line of credit. And all of those factors grow at the same rate. So your line of credit is growing at the same rate that the loan balance would have been growing. But if you mostly have this principal limit in the line of credit instead of the loan balance, it's the line of credit that's growing instead of the loan balance.
And Wade, how much can you borrow on a reverse mortgage? Because it's not necessarily millions of dollars.
So for someone with a multi-million-dollar home, they can still potentially benefit from the reverse mortgage. But this is something that's really much more focused on more like middle class or mass affluent types of Americans, because there is a lending limit. You can borrow on up to the first $636,150 of the home's value. And if you're of age 62 today, your principal limit, the amount you could borrow, would be about half of that. So you're looking at a maximum of around $300,000 of lending capacity. That's why if you do have a multi-million-dollar home and you still have a mortgage that's in excess of $1 million, you may not really be able to use the reverse mortgage very effectively to pay that off. But nonetheless, if you have paid off the home, you have that line of credit. It's a smaller percentage of your home value and of your overall probably household net worth, but it can still be a helpful tool.
And you're not making current interest payments, so Wade, when do those payments get made? When do the interest payments happen?
Well, it can be paid off voluntarily at any point, and one of the strategies could be to remove some of the loan balance, put it back into the line of credit, so it's line of credit growing instead. But otherwise, it actually becomes due once the borrower is no longer eligible for the loan, which could be for either because they've left the home, either through passing away, or because they've decided to move into a new home, or less common anymore, especially for those using it as part of a responsible plan. They're just not meeting homeowner obligations, they're not paying property taxes, or keeping up basic home maintenance.
Wade, that's great information. Thank you so much for joining us.
Oh, thanks. It's been a pleasure to be here.
It's Wade Pfau there, right there, buddy.
The man,
Were
right?
you nervous?
Big time.
Dr.
Sweating
Wade
it.
Pfau.
Talking to the man.
Talking reverse mortgages. Hey, guys, we got to take a break, but don't forget to get his book. Anyone that wants Wade Pfau's book, it's on reverse mortgages, kind of talking about all the different strategies that you might want to consider or to see if it is even appropriate for you. You can go to Your Money, Your Wealth. We'll be back in just a second to wrap up the show. Hey, welcome back to the show. Show's called Your Money or Wealth. Joe Anderson and Alan Clopine hanging out, talking about utilizing the equity in your home to create some retirement income. Want to thank Dr. Wade Pfau, CFA, PhD from the American College. He just joined us. If you missed it, you missed a great segment. Before we wrap up the show, let's get into the true-false question.
Retirees 62 years old or older can take a reverse mortgage without going through counseling. Oh, that's interesting. That's false, Joe. This is one of those new legislation items that was passed maybe 2, 3, 4 years ago.
What kind of counseling?
Yeah, well, financial counseling, right?
Oh.
Because there were some abuses in reverse mortgages in the past, and so that was one of the new things they came up with was anybody that wants to receive a reverse mortgage has to go through some financial counseling to make sure it works and it fits for them.
Yeah, I mean, because there was unscrupulous sales practices. But, you know, people would do a reverse mortgage and then take all the equity out of their house, and some salesperson would shove them into a product that probably wasn't in their best interest. There are definitely cons of a reverse mortgage. So I know we've talked about the pros, but let's get into the cons.
Yeah, and I think, Joe, first of all, is the fees may be higher in some cases on a reverse mortgage than a traditional mortgage. And, of course, instead of paying off your loan balance, it tends to increase over time. So you may be reducing your home equity.
Well, yeah, you're living off of it, right? And so the reason why the mortgage rates are going to be higher, because the bank's not going to get paid, right, until you die or sell the home. If you have a forward mortgage, you're paying that mortgage payment. The interest rate is going, right? You're paying that each month. Some of it's going to principal, some of it's going to interest, and the bank is getting paid. But in a reverse mortgage, that mortgage is being held inside of the equity of the overall home. You're utilizing some of your equity to live off of, but the other equity portion of your home is paying that mortgage payment. You don't have to pay anything into it, but as soon as you pass away, then that's when the note is passed. You know, if you don't want to do any of this, there's some also creative ways, Big Al, that people can do to create a couple of bucks, maybe a little side hustle or something.
Well,
rent out a room, or
yeah, there are, Joe. And let me just start out. If you don't mind having someone in your home with you, right?
You sleep right next to you, Big Al.
Yeah, same room.
Rent out your bed.
I was thinking of the room next door, but how about this? I mean, renting. A lot of retirees will end up if they live next to a college. Maybe they'll rent to a college student or maybe a young professional. Maybe that's an ongoing rental for a year. Or if you don't mind being kind of a little bit of a hotel, you could use VRBO or Airbnb and rent by the night or by the week. Now, in that case, they're probably staying there with you. You'd have a separate room. In some cases, people go on vacations, extended vacations for a month or two, and they'll rent out their home. They'll make some income that way. And Joe, I think, maybe the big one for you, right? When you retire, bed and breakfast. You got a home, you got a nice home with a lot of bedrooms. I think you're a perfect candidate for that.
I'm going to be like the Golden Girls.
Are you?
Right. Just rent out all the rooms.
Have a lot of roommates?
Yeah. And we'll play cards and smoke cigarettes, right? And smoke cigars, and it'll be great. I'll be 80 and have a bunch of guys.
Got it. Okay, well, that is a plan.
Right. All right. So let's go to the email bag. Let's see what you guys have to say today about your questions in regards to finance.
Okay, this is from Cindy in Elfin Forest. If my home goes underwater after I secure a reverse mortgage, will I or my children have to pay the additional debt? Boy, that's a great question, Cindy. What do you think of that, Joe?
Where's Elfin Forest?
That's up in North County. It's between the coast and Escondido.
I thought you said there was an elf in the forest.
No, it's around San Marcos. Give or take. Give or take.
Give or take.
It's a real place.
I have no idea. I wasn't
Elfin.
even paying attention to the question. I was just thinking about an elf in the forest.
All right, I'll answer the question then. The answer is no. You and your kids do not have to make the payments if the reverse mortgage loan is higher than the value of the home. It's what we call non-recourse, which means that you will never have to pay the mortgage if it exceeds the value of the home. In other words, the home, when it's sold, let's say you pass away, the home is sold, that's the only asset that can be used to cover that debt.
Right, so if you take a look at, let's explain home equity too, right? So what is home equity? You look at the market value of your home, right? And then you have a mortgage balance, and whatever's in between, that's your equity. And what a reverse mortgage does, it might eat up some of that equity. And if the home value increases, that's great, because then that added equity can go to your heirs. But if it goes down the other way and all of a sudden you have more mortgage balance than you do equity, is there going to be a payment at the end when you sell the house or when mom or dad dies? And then, as Al said, no, it's non-recourse, so there is no payment. So that's a pretty good benefit. Let's go to the second email question of the day.
Okay, number 2, Carlsbad. You know where Carlsbad is, right?
I do know where Carlsbad is.
Does it make sense for me to get a reverse mortgage to increase my cash flow so that I can delay claiming Social Security benefits? Wow, that's a very astute question. Joe, I'll let you take care of that one.
Right. If you look at it, this is a strategy that a lot of people are initially using, right? Instead of using the reverse mortgage as a last resort, they might be using that line of credit for a short period of time. Because as we've talked about on the show, the longer you delay Social Security, you're going to receive an 8% delayed retirement credit on your benefit once you reach full retirement age. So that's going to be a guaranteed higher income stream for the rest of your life. A lot of you are taking it early, but if you have more cash flow, let's say if you tap into the home equity for a period of 3 or 4, 5, 6 years, as you continue to delay that retirement credit or your retirement benefit, that might be a very good strategy. Also, when you look at the home equity line of credit or the reverse mortgage, that's going to be a tax-free income to you. So some of the strategies that we've talked about is in regards to taxes is maybe you do a Roth conversion. So now you're getting cash flow or income from that reverse mortgage. Potentially you could take money from your retirement account, convert it into a Roth IRA, delay your overall Social Security benefits at a lot higher rate, and then turn that on age 70, turn off the home equity line of credit, and then now you have a lot of money sitting in a Roth IRA. You know, you don't want to look at one strategy in a bubble. You want to look at multiple different things of what you can do to enhance your overall situation. Do you do a reverse mortgage? Do you do a Roth conversion? Do you delay Social Security? Do you take it right away? Well, all of these are intertwined, so you want to make sure that you have a well thought out plan before you make any type of decision. You know, to help you out, what we do is we have Wade Pfau's book. If you want to get a copy of that, you can go to yourmoneyyourwealth.com. yourmoneyyourwealth.com, or you can always stay tuned to us each and every week because we have a lot of good stuff.
Joe, I just want to agree with you. I mean, the reverse mortgage, you can combine other strategies with it, and in many cases, it will make sense for people that wouldn't even have thought otherwise.
Right.
And I think that book does a good job explaining that.
All right, we got to get the heck out of here. Hopefully you enjoyed it. We'll see you again next week. For Big Al Clopine, I'm Joe Anderson. You just watched another episode of Your Money, Your Wealth. Boom. Good job, Al.